Hi, I'm Dheeraj Vaidya, and today I'm going to break down something that confuses a lot of stock market beginners: futures and options, or what we commonly call that as FNOs. I've received countless messages asking me to explain this, so here we are. And this is an introductory lesson to help you understand the basics clearly. If you find this useful, let me know in the comments what finance topics you want me to cover next, and if I get enough requests, I'll make a video on that as well. So, let's get started. Have you ever promised to buy something in the future at today's price without having to pay the full amount now? Congratulations, you have already used the idea behind FNO without even knowing about it. In this video, I'll break down the exact idea step by step, starting from the absolute basic. So, first, let's understand what exactly FNO is. FNO stands for futures and options. But that's just the abbreviation, right? What does it actually mean? And here is a simple answer. FNO is a type of derivatives. Now I know what you're thinking. Great, I didn't understand FNO and now here there is another confusing term. Don't worry, let me explain derivatives in a very simple way. If you look up at the textbook definition, it says derivatives is a financial instrument whose value is derived from an underlying asset. Sounds complicated. Let me break down again with examples so that you actually understand. Think of it like this. There's Zomato Gold or Swiggy One membership, right? So when you buy that membership, its value depends entirely on how much order you place in food, doesn't it? If you order food frequently, the membership is valuable because you're getting discounts. And if you stop ordering food, that same membership becomes worthless to you. So the membership value is derived from the underlying activity, right? Which is what? Which is your food ordering. That's exactly how derivatives work in stock markets or commodities or currency markets as well. Let me give an example of a real market. First, stock derivatives. So let's say, there is a derivative based on L&T stock. If L&T share price goes up, the derivative's value also goes up. If the share price falls, the derivative's value also falls. The derivative simply follows its underlying asset. What is that? Here in this case, it is L&T stock. Now let's move to commodity derivatives. Take gold as an example. If you buy gold derivatives, its value increases only when the actual market price of gold rises. If gold price falls, the derivative value also falls as well. And next we have is the currency derivatives. Consider the US dollar. If you hold a dollar-based derivatives, its value rises when the dollar strengthens. And if the dollar weakens, the derivative value drops. And finally, we have the index derivatives. A very common example of index derivatives is Nifty derivatives. The value moves based on the Nifty index. So if Nifty index goes up, the derivative's value goes up. And if the Nifty index falls down, the derivative's value falls down as well. So at this point, the pattern in fact should be very clear. Okay? Moving on. Now that you understand what a derivative is, let's talk about different types of derivatives. There are actually 4 types of derivatives. First, forward. Then we have futures. Number 3 is options. And number 4 is swaps. But here's the thing. In the Indian stock markets, you can only actively trade in futures and options. Forwards and swaps aren't available for the retail trading on exchanges. So when people say they are trading in derivatives, they're usually referring to futures or options. Now, you might be wondering what's the difference between futures and options. In fact, that's a whole separate topic altogether. We can cover it in some other video. Let's move on to the next part. Why do derivatives exist? And this is a very important question. Why do we actually need derivatives when we can just buy or sell stocks directly? Well, derivatives serve 2 primary purposes. The first is speculation. Speculation simply means you're making an educated guess about the stock markets to earn profit. For example, if I believe that the market is going to rise, I can take a position that benefits from the movement, right? Or if I think the market will fall, I take a position that profits from the decline. Let me give a real life example. Let's say, Nifty is trading around 26,000. trader, let's say his name is Rohan, felt that the market is overheated and it's likely to drop. So, what will he do? He'll sell Nifty futures at 26,000. Now, you might be wondering, how can you sell something which you don't own? And that's the beauty of derivatives. You can sell first and buy later, and that is called as short selling. So, Rohan sold at 26,000 and now he's waiting for the market to fall. If Nifty drops to say 24,500, he'll buy it back at 26,000, right? So his profit will be the difference between the two, right? So that will be 1,500 points. Selling high first and buying low later gives him the same profit as buying low first and selling high later. The order doesn't matter. What matters is capturing the price difference. And this is called as speculation. He took a position because he believed the market would move in a certain direction and he wanted to profit from the movement. And now let's understand purpose number two, and that is hedging. Hedging is completely different from speculation. While speculation is all about making profits, hedging is about, reducing losses. And let me explain with an example. Suppose, I bought a large portfolio stock when the market was at 20,000. So I invested, let's say, around a crore. Now the market starts falling. My portfolio value also stops falling, right? If I do nothing, I face significant losses. But what if I could offset that losses? And that's where derivatives come in. I can sell Nifty futures. As the market falls and my portfolio loses value, my short position in Nifty futures will start making profit, isn't it? So the losses in my portfolio are compensated by the profit in my derivatives position. And this is called as hedging, using derivatives to protect yourself from losses. But here's the crucial point. Whether you are speculating or hedging, the actual trading mechanics are exactly the same. You buy or sell derivatives. What changes is just the intention. So if your goal is to make profit, we call it speculation. If your goal is to minimize risk, it's called as hedging. It's that simple. Well, that was my attempt at explaining futures and options in the simplest way possible. I remember I first started learning about derivatives. I bought a very thick book on FNO trading and sat down with a cup of coffee, and after just reading 10 pages, I had to close that book. I felt completely overwhelmed with the technical jargons and complex formulas. I felt completely lost. That experience taught me something very, very important. When it comes to topics like futures and options, it's better to take slowly and understand things in depth rather than rushing everything at once. And that's exactly the approach I wanted to take with this video, keeping it very, very simple as well as foundational. I hope this basic introduction help you understand derivatives, what derivatives are, and why they exist in the market. Sometimes, having a clear understanding of the fundamentals is far more valuable than jumping into complex strategies without knowing the basics. If you found this video useful, if you found this explanation useful and easy to understand, please do hit the like button. It really motivates me to create more such content. And if you haven't already, subscribe to the channel and press the bell icon so you get notified when I upload new videos. And if you know someone who have been confused about FNO, share this video with them. Sometimes the simplest explanation are the most powerful ones. And that's all from my side. See you in the next video.